there. Welcome to Trading Day. I'm Lindsay Biscaya. Let's get to some of the stories we're following in the BNN Bloomberg newsroom. Canada is now officially in a recession. This comes after 2 consecutive quarters of negative growth. The GDP shrank 0.1% in the first quarter when it was forecast to grow 1.5%. Rendell Bartlett is deputy chief economist at Desjardins Group, and he says the arrival of a recession was a big surprise.
Nobody saw that coming. When you look at the distribution of consensus, everybody was in positive territory. The median of consensus was 1.5% annualized increase in the first quarter, and that matches what the Bank of Canada had too back in its April monetary policy report. So, big surprise there. Not something that folks had expected.
Apotex has filed for an initial public offering in Toronto, setting the stage for one of Canada's largest stock market debuts in recent years. Bloomberg News previously reported the company could raise up to $1 billion through that offering. The generic drug maker says the IPO will include newly issued shares, as well as shares sold by controlling stakeholders, SK Capital Partners. And the Bank of Nova Scotia has agreed to purchase Maple Financial Holdings. This is the parent company of Maple Mark Bank, a commercial bank operating primarily in Dallas. The terms were not disclosed, but Scotiabank says the acquisition supports its strategic focus within North America and says the move will allow it to offer deposit insurance to clients. And we're keeping an eye on the TSX today. It is up by just ever so slightly, actually. It's trading pretty flat at the moment, but it's seeing some gains today. We'll continue to watch that. We're also watching U.S. markets. Stocks seem to be rising kind of across the board. This comes after Trump said he will make a call in Iran soon. So the Dow Jones in particular up by 0.6% at the moment. The Canadian economy is in a technical recession as real GDP fell this quarter following last quarter's 1% drop. Should this impact your portfolio strategy? Joining us now to provide some insight is Sam LaBelle, portfolio manager at Veritas Asset Management. It's great to have you join us.
Thanks for having me.
Okay, we are now officially in a recession. What do you make of that, and how should investors kind of be positioning their portfolio with that in mind?
Well, they said it was a surprise, but we did have a negative quarter in Q4, and just recently we had a downgrade of the U.S. growth rate from 2 to 1.5 on revision. So it's the old adage that if the U.S. sneezes, Canada catches the cold. But there's also obviously a lot of things going on with trade. It's kind of deterring investment in climate has been very poor in Canada because you're not sure what the end regime is going to look like. So a lot of these things have slowed, and population growth has slowed. We've cut back on immigration. So a lot of the key drivers of some of the things that were working for us in terms of GDP growth have kind of gone flat. Housing market is another area that's been kind of in decline. Prices down, people not buying as much. So there's a lot of areas of the economy that are kind of stalled, and we would say that this number is obviously subject to revision at a later date. But that revision could go either direction. Technical recession means that the economy was in decline. So as we look forward and as you consider your portfolio, you should always be looking forward. The question is what can kind of reboot growth? There has been some investment in oil and gas and mining and some of these projects that are moving forward. So there should be some momentum to move that growth rate back up to positive, but overall the Canadian economy definitely struggling.
Okay, so and obviously we saw Canadian bank earnings coming out this week, right? I'm not sure how that correlates or if it does at all with what we've been seeing with the GDP and the Canadian economy, but what are your thoughts on the results that we saw from the big 6 banks this week?
Well, the banks have always been kind of a proxy for economic growth. When the economy does well, banks tend to do well as they make loans and the economy expands. But the big 6 banks in Canada also have a very strong wealth management business. A number of them have made investments in the United States. So it's not strictly a Canadian story anymore. You kind of have the exposure to the global equity markets in the wealth management business. Very strong stock returns push up assets. You earn more fees at the bank. Capital markets activity has been pretty strong. So the main detractor from the economic growth side is usually seen in the personal and commercial loans, and those were relatively relatively good for the quarter when you looked at the big six banks. Provisions were down. Some of them benefited from better provisioning in the US, a little bit of reversals there. So overall, provisions came in a little bit better than what people were expecting. So there's not really a five-alarm fire going on in terms of credit for the banks, but we do watch that closely because we had experience here where a bad year for credit provisioning can really wipe out a year of growth and earnings. And you're kind of positioned to get 4 to 8% earnings per share growth with that 2.5–3% dividend yield. That's not a bad place to be for a long-term investment in banks.
Okay, so let's move on because you mentioned earlier the trade talks that are coming up this summer, the CUSMA renegotiations with the U.S. and Mexico and Canada, of course. I'm wondering what you think Canada should be doing in terms of trade negotiation strategy here. We did hear Prime Minister Mark Carney saying earlier this week in the U.S. that Canada can make America great again. How do you think Canada should be approaching these talks? Do you think we should kind of wait and see how Mexico does with negotiating before really hammering in a strategy?
Well, we're kind of at the mercy of how the U.S. wants to approach this whole problem. There is this deadline coming up, the sunset clause deadline, which people have made a lot of noise about. But ultimately, that's a decision whether or not to extend the agreement. If the agreement's not extended, it goes into this perpetual one-year review cycle until it terminates in 2036. So it's just more of the same. We're already negotiating. That would just extend the negotiations into this annual review and extension decision process. So we're kind of in limbo already. The biggest nuclear option in the agreement is that any party can leave with 6 months' notice, and we hope that that's not ever triggered. But in the meantime, the U.S. is really dictating the pace. They've decided how negotiations are going to take place, with whom, and they've decided to go the route where they're going to negotiate just between two parties, starting with Mexico. The Mexican negotiations have kicked off and will go into June. So Canada has an opportunity here to kind of stand back and see how Mexico approaches the problem, how the U.S. approaches the problem, and then craft hopefully a strategy that we can work more closely with the U.S. But we have very different trade objectives than Mexico does. Obviously, we have a lot less agricultural trade importance and a lot more manufacturing trade. Our manufacturing trade looks a lot more like the U.S. activities, so we are trying to sell the idea that this is complementary and helps the U.S. industry. And Mexico has a lower wage base, and so they're looking at different industry exposures than we are. So it does kind of make sense for the U.S. if they're trying to maximize their concessions to go at each country separately, and there's less common ground between Canada and Mexico right now. But in the meantime, Canada is under maybe the best case tariff in that all of the CUSMA, all the US, or you want to call it USMCA, any goods that are compliant with that are exempted from tariffs, even the 10% blanket tariff that has been put on, with the exception of certain industries, steel and aluminum. So that is perhaps the best agreement we can get. Without making further concessions. I'm not sure that we're going to get those steel and aluminum tariffs lifted. It's very much part of the policy of the Trump administration. But in the meantime, as we watch the U.S. negotiate with Mexico, that's going to stretch out. And by the fall, we do have some midterm elections. So it's possible even that the Trump administration could be weakened on the trade file if the fall midterms don't go their way. So a hurry up and wait strategy isn't the worst thing in the world because, again, we're not really ready to give up concessions, and the U.S. has been making continual demands for concessions that we're not necessarily prepared to make.
Okay, and there's just so much to cover here today because a lot is happening. We're obviously seeing a lot of stocks rising today on the news that Donald Trump has announced the U.S. is lifting its blockade of the Strait of Hormuz. With all of that in consideration, we've got the CUSMA renegotiations we were just talking about, Canada's recession. Just on a last note, like, how should investors really be positioning their portfolio with all of this in mind? Is there any areas you're staying away from, any you think are particularly safe amongst all this volatility?
Well, I think it's good news for the Strait to reopen. We've kind of been cushioned from any fallout from the interruption of oil supply out of the Middle East because most of the stockpiles around the world are being liquidated. The U.S. drew 1.8 million barrels a day over the last 4 weeks from its strategic reserve. China is the draw on China is even higher, and Europe liquidated about 400 million barrels right at the start of the conflict. So all of that oil flowing onto the market has cushioned us from this interruption of about 20% of the world's supply. So a reopening of the Strait of Hormuz is good news. I would say keep an eye on the back end of the oil futures curve, because the December oil future really signals what the market thinks about the reopening prospects. It's a good indicator in terms of what's being priced in. So that's still in the high 70s. And one of the things that I think to think about is that those oil reserves will be replenished over time. Most countries are going to want to fill those back up after the strait reopens and after there's actual supply coming in. So there'll be a source of demand here for oil extending out probably 6 months to a year in terms of reserve replenishment on top of buying in the end consumer markets and industrial markets. So oil could have a little bit more strength than people are anticipating. We think an oil price in the 70s is very reasonable. And then that price, companies like Cenovus or Canadian Natural are generating very good free cash flow yields and can invest potentially in expanding production.
Okay, we'll leave it there. Sam LaBelle, Portfolio Manager at Veritas Asset Management. Appreciate your time. Thank you for joining us.
Thanks for having me.
Up next, Canada is slipping into a technical recession, as we were just talking about, and this is the first time that's happened since the pandemic. So we will break down what dragged the economy down and where it goes from here. Stay tuned. The Canadian economy has edged into a technical recession in the first quarter, with real GDP falling. Economists had been bracing for a 1.5% gain. So the surprise miss comes as U.S. tariffs keep squeezing businesses. To make sense of it all, earlier we were joined by Claire Fan, senior economist at RBC.
Unlike sort of the contraction that we saw in the fourth quarter of 2025, this particular, well, GDP really in real terms was pretty much unchanged. A lot of it, where the softness unexpectedly came from weaker business structure spending. So these are, for example, commercial buildings, railways, et cetera, and major renovation projects. And on the government side as well, there was a fairly large sort of decline in their spending on weapon systems, so defense spending as well, even though it's still historically pretty elevated. So I think those two things were sort of the surprise factor on the downside that really dragged the so-called final domestic demand component down. To your point, on the export side, we're still seeing negative impact really of U.S. tariff really impacting auto exports to the United States, even though we've seen a huge imports as well, mostly just tied to precious metal, to be offset by a huge run-up in inventory. So I think, again, back to the consumer side of things, which is really the last component on the expenditure side of things, we're still tracking a lot of resilience there.
Okay, let's go back to the businesses for a second. The hesitation on spending, is that tariffs that's doing that, or concerns about the economy?
Yeah, I think that definitely, just rising uncertainty due to the economy. A lot of this, where most of it, again, is coming from factors that are outside of Canada, because, again, what we're seeing repeatedly throughout 2025 is resilience within domestic spending. So some of these sort of declines in terms of business investment, although it has been weak pretty much for the last decade or so, has more to do with external factor. Number one is tariff, like you mentioned. Number two is the fact that, a lot of geopolitical headwinds are just escalating right now or persisting much longer than what we had initially expected. Oil prices, which are a key input cost when it comes to fuel costs to businesses, they're still quite elevated at this moment. So I think a lot of businesses are probably just holding off again in terms of not putting forward that investment dollar that they otherwise would have.
All right, and now with the government, the drop off, is that a permanent thing, or is it something that just didn't happen this quarter?
I think the key thing here is to note that the defense spending number, especially on weapons system, is still historically very elevated. It still has a share of GDP 3 times what it was historically. So it's a bit smaller, but that's just on a relative term comparing to pretty solid spending in 2025. So hardly anything, a big change over there. Still pretty resilient spending in defense.
All right, and then the other one you mentioned, household spending actually rose 1.5%, but savings are down, and it sounds like people are digging in. And are they picking and choosing where they're spending?
That's a great question. And that is by far, that's the key question moving forward as well. The longer oil prices and gasoline prices stay high, really what we're watching for is the component of household spending that account for half of the economy on the expenditure side. And so far as April goes, which is the first sort of month into the second quarter, and also sort of the second month that gasoline prices have persisted at pretty elevated levels, we're still tracking some signs of resilience of households, mostly, like you said, dipping into their savings rate. We did see savings rate fall again to 3.5% in the first quarter. And for some lower income households, potentially utilizing personal sort of credit cards, other debt to really spend through this initial period of higher gasoline prices. But that is the key question mark going forward, is just how much of this so-called demand destruction is going to come through. So our estimate is that currently households on average in a month, on average, each Canadian household is spending about $75 to $100 more just on gasoline prices. So it's getting to a level where it can become pretty uncomfortable for a lot of lower income households. So far, no significant signs of demand destruction. Even back in sort of the Q1 data, which of course only covered part of sort of the elevated gasoline price period, we did see pretty solid spending again on services. We saw a pullback in auto spending, and that's something discretionary. So perhaps some weakness already seeping through. But again, that is sort of one thing that we will be watching very closely moving forward.
All right, and technically this is a recession, but it was like I think it's 0.1 and 0.1 the 2 quarters. When they take a second look, any indicators that might get revised up into either zero or into a positive?
Right. So this is the thing. And the other thing is also that, when we do look at GDP data from an economist perspective, there is the expenditure side of things that fell slightly, like you mentioned. But there is also sort of the income side of things, which is the production-based expenditure data. So those two don't really reconcile all of the time, but usually historically the gap is pretty small. It just so happens that the past 2 quarters we've seen pretty big gap in these two set of quarterly statistics. So on the sort of income side, GDP actually grew on a quarterly basis. So that's also something to keep in mind. But definitely past trends in terms of GDP, we've seen consecutive upward revision in GDP components. Now, I can't really point to exactly which component over there that could be revised higher this time around, but certainly if that trend were to extend into sort of a first quarter statistic, it could definitely tip things into a small positive, if anything. So I think down to the bottom, what you're getting at is, will we characterize this really as a recession for the Canadian economy? And I think we're just not quite there yet. Again, some of the resilience that I pointed to when it comes to consumer spending on the household side, as well as sort of pretty resilient, again, government spending still, are all sort of signs that underlie some amount of resilience in the Canadian economy, despite the gloomy headline numbers.
That was Claire Fenn, senior economist at RBC. Well, shares of the Gap are plummeting after the clothing retailer cut its full-year sales outlook due to struggles with its product mix. We'll hear from the company's CEO right after the break. Stay with us. Shares of the Gap are plummeting today. That's after the clothing retailer cut its full-year sales outlook due to struggles with its product mix. For more, our partners at Bloomberg Television spoke with the company's CEO, Richard Dickson.
We actually delivered progress this quarter, and we delivered it against several key metrics. Important to recognize, this is our 9th consecutive quarter of positive comparable sales. 3 out of our 4 brands are growing. Comps were up 2%, and that's building on 2% comp growth from last year. We outperformed our gross margin outlook by 30 basis points. We won across all income cohorts, gained share as our value proposition across the board continues to resonate. And we returned $450 million in cash to shareholders through dividends and share repurchases. As you call out, performance at the brand level was varied. First, standout quarter at Gap brand, up double digit, 10%, on top of 5% last year. Old Navy delivered growth, up 1% comp on top of last year's 3% growth. Now, that also marks the brand's 6th consecutive quarter of positive comps. We've been pursuing categories like denim, active, kids and baby, all which posted growth versus last year, and they continue to build relevance with our customers. Seasonal categories have gotten off to a weaker start, in particular dresses, where we just did not have the right fashion and value equation. We actually overinvested some sales and inventory and didn't necessarily correctly anticipate what ended up to be a decline in the dress market. Where our dress assortment actually did resonate was in occasion dressing, which has more specific end use, like weddings and Easter. We've seen a change in customer acceptance of dresses during key peak moments. So summer stock up, instead shifting more to versatile categories and styles that can be worn, let's call it year-round.
One thing that I found
as we get through the seasonal dynamic, we're looking forward, obviously, to the back half, and I'm very confident in our ability to drive improvement.
You know, it's really notable, Richard, that both you and American Eagle came out, reported certain pockets of disappointment amid otherwise robust performance, and talked about how it wasn't because the consumer demand wasn't there. It was because of specific missteps. Is there something about the environment right now that makes it harder to get these things right? Because two different companies called out something similar in terms of style issues, fashion issues. Is it a moment, or is it just the fashion industry?
Look, I probably think it's both. I mean, the fashion industry is a dynamic industry. To your point, we are seeing consistency and strength in consumer behavior. But ultimately, you know, this is a dialogue with consumers that you have to follow and ultimately drive. And in this particular case, again, when you back up and you look at our whole portfolio, gain share, consistency in growth, 9 consecutive quarters, 3 out of 4 brands growing, growth across all income cohorts, very specific call out on a category that, by the way, as we enter the second half, is very small. And so, again, you know, this was to some extent, you know, the dynamic, the business that we're in, softness in the women's dress business, but ultimately we believe as a portfolio, we've got, you know, great room and a great back half ahead of us.
Why do you think then that investors don't seem to be feeling that this morning? You see shares lower by more than 16% year to date. Shares are also lower by a similar amount. Why aren't they reflecting the strength that you're talking about?
Look, we feel very confident in where we're at and where we're going. We see great strength at the Gap brand, which, again, is incredible double-digit growth. We've got now continued growth at Banana Republic. We just reported our 4th consecutive quarter. Old Navy did deliver 1% comp, and while we expect sales to deliver flat to 1% now, low single digits in the Q2, and then moderated growth in the second half, with the seasonal categories off to a weaker start, in particular dresses, we are obviously on balance taking a more moderated view of the total year. We are also holding our operating margin outlook. Our gross margin outlook is unchanged at flat to up slightly. We're continuing to maintain cost disciplines with SG&A as a rate to sales that's flat. And despite the lower sales outlook, which, by the way, still represents growth, we're raising our earnings outlook from $2.30 to $2.40, which reflects 11% growth year over year at the midpoint. And while this is our outlook currently on the top line, we aspire to outperform it as the brands strive for continuous improvement.
That's where I wanted to go.
This is a long game. The company's in a healthy space, and we're excited about what we have ahead.
Richard, I am curious how much upside there is potentially if you do get some of those tariff rebates that a lot of people were talking about. Are you expecting that to potentially lead to an upside surprise?
You know, we are, you know, we're an importer of record, so we qualify for a refund. That said, we use the reconciliation method, which has currently been excluded from phase 1. We've been encouraged by the progress that has been made for phase 1 applicants in our industry. However, without being included in phase 1, the situation does remain fluid as to when and what amount of refund will ultimately be realized. Therefore, we're not providing a quantification at this point. We haven't assumed any benefit in our outlook, but of course, you know, we anticipate anticipate that we'll share more as things become more tangible.
So, Richard, just before I let you go, the takeaway here is that casual dresses for the summer, not really in anymore. Is that sort of not what's going on? That instead we're going to be in jeans?
I think we overweighted our expectation of the dress category. Dresses are still an important category. People are still wearing dresses. What we do see is it's just more occasion-based, whereas we drove more of that everyday dressing in mind, and we did see a shift. And so dresses are still important. We've got this. We're doing our best to move through the seasonal product. And again, as we move into the back half and the seasonal products are behind us, we think we've got great programs in place to drive growth.
That was Richard Dixon, CEO of The Gap, speaking with our partners at Bloomberg Television. Coming up, Canada's agricultural sector is already a powerhouse, but is it becoming a major investment story? We'll get more from the president and CEO of Farm Credit Canada when we come back. Canada's economy is now in recession after GDP shrunk in 2 consecutive quarters. First quarter GDP dropped because of weakness in resource extraction industries and in construction activity. The results fell well below the growth forecast of 1.5%. StatsCan says it's the first recession since the 2020 COVID-19 pandemic. Oil prices are down today after U.S. President Donald Trump indicated he will make a final determination about a deal with Iran. He says there are multiple conditions for a deal, including an immediate reopening of the Strait of Hormuz without tolls. Trump also says the U.S. naval blockade against Iran will now be lifted, although he didn't specify when. Shares of Dell are soaring today. This follows the computer maker's outlook for annual sales that far surpassed analyst estimates. Dell says revenue in its upcoming fiscal year will be about $167 billion US. That includes $60 billion from the sale of AI servers. The company's servers are designed to run AI workloads and are attracting customers from a variety of firms. And we're watching the TSX today. It is gaining up by about 0.2%, so not gaining by a lot, but the Infotech Index, followed by the materials, seems to be boosting the TSX up today. We're also watching markets south of the border. It seems as though stocks are rising after Donald Trump says he will make a call on Iran soon. The Dow Jones in particular up by 0.6% at the moment. Canada's agricultural sector is shifting from a traditional export story to a modern growth engine focused on investment, innovation, and global demand. And Farm Credit Canada is helping to drive that shift. So for more on what's fueling their momentum, let's bring in Justine Hendricks, President and CEO of Farm Credit Canada. It's great to have you join us. Thanks so much.
Great to be here.
So when it comes to the agricultural sector in Canada, what should investors be paying close attention to, do you think?
Well, what they should be paying close attention to is, first of all, as a sector itself today, it's a huge driver of the Canadian economy. It represents about 1 in 9 jobs. It's about $150 billion of our GDP. It's a safe sector. Our food and our food production is sought out around the world. And that's what's bringing a real opportunity as we shed a light on some of the interesting things that are happening in the sector, but moreover, the opportunity for Canada to really step up and take the opportunity to see where we can go with it.
Because I think a lot of Canadians hear agriculture, like that word, and they think only about farming. But when it comes to these opportunities you're talking about, like where do you see the biggest growth opportunities across the agri-foods economy, really?
So great question. And I'd like to say the opportunity is across the entire value chain. So the success of processing depends on the success of farmers. The more innovation and investment in ag tech and ag food is where we're going to see that drive to a higher productivity. But it all starts with innovation and the ability to turn that innovation into scaling opportunities and commercializing them. And perhaps a stat to give the audience a sense, like if you take a look at the performance of the Canadian egg and food sector in the last 10 years, from a GDP growth rate percentage, it's performed better than the rest of the other sectors in the Canadian economy. So it's not just of a new interest, it's a sector that's delivered consistently and now is really positioning itself for the next scaling opportunity.
I wonder, though, is there a lot of headwinds within this sector? Because you think of like geopolitical tensions, like the trade war that's ongoing. Obviously, the Strait of Hormuz closure has boosted up a lot of fertilizer prices, climate change even. Like, are there some big challenges that this sector is facing, particularly farmers?
There's definitely changes and challenges. But what I would like to say is this sector is definitely known for its resilience. And how you take a look at that, too, is when you are faced with some of those challenges, the reality is it can also present some opportunities. So it's certainly not to say that some of the geopolitical realities, what we're also tracking around the world, isn't putting pressure on the sector. But what we do know is that in these times, these are some of the most important times for investing. And that, as you work your way through that volatility, gets you ready for when the demand returns or starts to accelerate again. And we also see, when I dig into the agri-food side of things, those agri-food companies, Canadian companies that export to more than one market are the ones that are being the most successful. So it is definitely a combination of what you deliver and what you bring to Canada, how you set yourself up, but then this ability to scale not just to one market, but to several is really part of the equation of success.
So have you been successful in attracting more, maybe not just you specifically, but the sector? Has it been successful in attracting more like large scale investments recently, or is that still something that's been worked upon?
No, well, actually, we do have a start to that. So earlier in the year, we were able to bring together a coalition of private investors, institutional investors, and together, FCC committed in May that we would invest $2 billion in ag and food tech between now and 2030. And this coalition came together and added an additional $5 billion to that commitment. So what essentially that means, the total $7 billion to be deployed to ag and food represents the largest investment or commitment to this sector for at least the last 30 years. So we have been successful in piquing the interest of not just investors that traditionally invest in the sector, but we've been able to seek the interests of those that do not traditionally invest in the sector. And to us, it's a real sign that the story is getting out there and the potential is there and people want to be part of the success story.
Okay, I did want to ask you about that, the $7 billion in investments that you've managed to raise. What kind of opportunities are these investors the most excited in when it comes to investing in this sector? And where do you think the strongest long-term returns could come from here?
Well, I think the opportunities are multiple, right? How the sector, both in ag and agri-food, can lean in on AI opportunities, lean in on automation, and the real desire is to be able to be as best positioned for scale and growth. But in order to do that, we need to bring those ideas to commercialization. Mm-hmm. And to give you a sense, like we've tracked, if you compare the Canadian investment horizon towards ag and food compared to that south of the border, the ratio of how much investment dollars go to this sector is 23-1 in the U.S. vis-a-vis Canada. So the role of coming together with this coalition was to very much be a catalyst, not just to bring private investors to the sector and to be able to crowd in that capital and invest in those innovations. And those innovations, as they turn into successful ideas and go into production, will connect back to increasing our productivity. So I would argue that the opportunities are across the value chain. And it goes back to that principle that your successful agri-food business or processor needs an input from somewhere. So the success is required to be at the farm gate as well. So, and we see opportunities across the entire value chain.
Okay, that's all the time we have. So we're going to have to leave it there. But I know you are at the Thrive conference in BC right now. So I appreciate you taking the time. Thanks so much.
It's a pleasure.
That is Justine Hendricks, President and CEO of Farm Credit Canada. Well, shares of Costco are falling after the retail giant's better than expected results failed to impress investors. So we'll go over the full results after the break. Stay with us. Shares of Costco Wholesale are moving lower today after the company's better than expected third quarter results weren't quite enough to please Wall Street. Earlier, we were joined by Michael Baker, Managing Director and Senior Research Analyst at D.A. Davidson.
When you're trading at 45 or 46 times earnings, you really need an A or an A plus for the stock not to be hit, at least a little bit. There were a lot of good things in this report, but there were some, what we call yellow flags or things to keep our eye out on.
Okay, let's talk about the good. What do you like?
Same-store sales, really. I mean, they do report them monthly, so they were largely known. But they're great, 6 or 7% in the U.S., excluding any impact from gas or foreign exchange. Very steady in that range, no matter what the economic environment. So consumers are showing up and they're spending. There's really no problems at all in terms of what we're seeing in terms of the sales trends.
And what's interesting with that, they were concerned about their membership numbers, though. I mean, they're coming to buy, but people aren't coming to join, though, are they? Or not as much as some people would like.
Correct. Well, they're still seeing growth in membership on a year-over-year basis. It was about 4% growth. That's a good number, but it has been steadily decelerating. So still up year-over-year, but up less so than it had been. We saw a big surge during the pandemic, and it's been sort of slowly coming down since then. It's now 5 or 6, if not 7 quarters in a row where we've seen that growth rate in membership up, but up less than it was the previous quarter. So a little bit of a deceleration. And again, when you're trading at 45 times, anything less than perfect is going to raise some eyebrows.
Is that a case of just coming more back to reality, more of an expected number?
I think that's part of it. And specifically, what they're seeing is they're seeing less big, massive club openings in foreign countries. So, for instance, they had some really big openings in China or Japan, and that really does drive that membership number to be a little bit higher. You are seeing a little bit fewer of those big openings, and so that's naturally going to lead to less membership growth. Now, on the other hand, those new members, those big clubs in new countries tend to have really high initial signups, but a little bit smaller renewal rates. So this could actually show up in better renewal rates over time. But for now, we are seeing that less growth. And again, investors are going to be focused on that and that trend that we're seeing. And it is a little bit, to your point, a reversion to the mean besides that dynamic. And one idea is if that's going to revert to the mean, then maybe the valuation reverts back to the mean, which it's always been a premium valuation, but at where it is now, it's a little bit towards the higher end of where it's been historically.
All right, let's talk about gas a little. Unprecedented demand is how Costco describes it. What kind of an impact did that have?
Yeah, we are seeing that really for all the clubs. You're seeing certainly increases in their sales of gas, not only because price per gallon is up, but also they are taking share in terms of gallons because consumers are coming to them because of the discounts. There's a little bit of sticker shock when it relates to gas prices in the U.S. And so consumers are willing to drive actually a little bit further to save the 25 or 30 or even 50 cents that you will at the clubs. So it's definitely helping the sales trends. It is profit accretive in terms of dollars, but it does drag down the margins a little bit because gas is a lower margin business. One dynamic that's interesting is that when consumers come to the gas station, they do tend to then go into the club to do some additional shopping. That's somewhere around 50% of that crossover. That number really hasn't changed very much. In fact, we think it might be down a little bit because we're getting a lot of consumers that are just coming for the gas right now and not even going into the club. So that's a dynamic to watch. But generally speaking, higher gas prices does tend to be favorable for the clubs just because of the traffic that it drives.
And then on the expense side, what kind of an impact is gas having on that for the company itself?
Well, again, the profit, it is a profitable business. The profits per gallon, so we call it pennies per gallon, were actually up a little bit during the quarter. But it does mix down within the entire mix, because even if profits are up in gas, it's still a lower margin business than other parts of the club. And in fact, even though it's up on a penny per gallon basis, it's actually probably down on a percent basis, because the increase in pennies per gallon were not as much as the increase in the overall price of gasoline. So gasoline's a little bit of a complicated dynamic, but generally speaking, it is accretive to dollars, but less so in terms of margins.
And I should have elaborated more. I meant as an expense for the company paying for fuel to drive their trucks and move products around. What kind of an impact is that having?
Understood. Right. That did have an impact on their overall gross margin. So one of the other issues with the report, making it less than perfect, is that gross margins were down. Part of that is the dynamic to the mix shift towards gas prices. Part of it is they are investing a little bit in price to give back some value to consumers. We saw that in areas like eggs and protein. But a third factor is their supply chain costs have gone up because of higher gas prices or fuel costs and transportation costs. Generally speaking, we think that's something that Costco is pretty good at managing and should be able to overcome, at least relative to other retailers. But that is a pressure point for Costco and really all retail right now.
That was Michael Baker, Managing Director and Senior Research Analyst at D.A. Davidson. And coming up, we will zero in on the stocks that actually make money with John Ehrlichman. That's after the break. Stay with us. Companies that are great at making money are often great stock picks for investors, but finding them involves more than just reviewing earnings performance. BNN Bloomberg contributor John Ehrlichman joined us earlier for more on that.
We often look at earnings. We cover earnings season. We look at profitability in any given quarter, and that's a great determination on whether a company is making money. But it's not the only determination, and sometimes it's actually misleading because it's not the only way that companies get a return. Obviously, running your business and generating a profit is important, but the reality of public companies, Roger, is they're getting capital from all sorts of areas, including to finance their business, right? They're going to the stock market, the bond market, they're taking capital, and oftentimes they are judged on how they allocate that capital. Warren Buffett has a favorite tool called return on invested capital, ROIC. And David Driscoll, who we spoke to in the latest episode of Ticker Take, loves ROIC as well, because it really gives you a sense of how well companies use the money they have and what they've got left over at the end of the day to do great things with, either in the business or to reward investors. And it's funny, Driscoll, who's been on BNN many times over the years, he used to work in the bond rating industry, and companies would come in and they'd try to prove their ROIC worth to get a good rating, and they thought, that could be a good measure for stock analysis, and it's proven to be a great one for him.
And he did, and Warren Buffett did all right with that. Okay, so how is David done, and what is he liking?
He's done really well over the years, and he's proud that in a couple of cases, he's actually been ahead of Buffett on a couple of Buffett picks. Let me give you a few examples that came out of our conversation. I mean, there were 10 in total, but let's use the AI and tech boom. So ASML, we don't talk as much about it. It's a European chip equipment player, but as the AI boom continues, the AI chip makers will be coming to ASML. It gives you some diversification, according to Driscoll, because they're European-based and they're excellent stewards of capital. Staying with tech, you got a company like Lam Research. Same kind of diversification play in that they've got a lot of customers in Asia, which he likes, but they also have a good track record when it comes to doing great things with the money that comes in. And then a company that actually Berkshire and Driscoll have in their portfolio is Chubb. People might know the name. They're in the insurance game. They're really good at not giving away all their money to all the insurance claims, and every dollar that they're able to keep, obviously they can do more with that. So those are a few examples.
And you can find John's full story on our website, as well as the Ticker Take YouTube channel and podcast. Okay, let's take a quick look at the markets before we go here. We'll start with, we'll just take a look at the North American markets in general. The TSX is up today, seeing gains after it saw gains yesterday as well. Info Tech Index and materials are the big drivers on the TSX. At the bottom comes in energy. Obviously, we're seeing the price of oil falling today as Donald Trump says that he's willing to make a decision soon on what's happening in Iran, potentially reopening the Strait of Hormuz. That seems to be boosting the S&P 500 and the NASDAQ today, too. Not big gains here, but we're seeing a 0.1% increase for the S&P, and then NASDAQ is trading relatively flat, but still in the green. That wraps up this edition of Trading Day. Thanks so much for watching.